The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box Europe. I'm Karen Cho with Sylvia Amaro, and these are your headlines. European stocks edge lower in thin trade, but the Stoxx 600 remains on track for its best year since 2021.
Oil prices rise and gold hits another fresh record high as U.S. forces pursue a third oil tanker off the coast of Venezuela. U.S. officials hail productive talks with Russia and Ukraine, but the negotiations end with no sign of a breakthrough.
And welcome if you are just joining us, and thank you to all the viewers sticking with us right through to Christmas. You may notice we've got a shortened show as we head into the festivities at just 2 hours this week. And of course, Sylvia, not on the early shift, so nice to see you.
Yeah, it's a bit of a different shift for me this week, but I'm very excited to be with you this week, Karen, of course. And of course, at a time when, the trading year is coming to an end, but what an exciting one it has been.
Yeah, as we talk about that, I think the sentiment, I was reading a gauge this morning, this was from Bank of America, which struck me because they're talking about the measure of investor sentiment that has moved into extreme bullish territory at 8.5, which can often be a precursor to a reversal. It doesn't feel like we're in bullish territory, though. If you look at some of the moves on the market, it is modest territory in Europe and the States. It's actually often different directions in some of the asset classes, that whether the Dow's up and the Nasdaq's down or reverses at any given point. It doesn't feel as though we're in bullish territory.
And where is the Santa rally? We haven't really witnessed that this year, right? So I'm wondering, where do we go from here? It's important to look at the commentary that we have gathered so far in recent weeks. And it just seems that there's a strong opinion out there that you just need more diversification as you look at 2026. In comparison to where we were this time last year, it seems that there is a consensus narrative lacking at this stage. Of course, at that time, it was all about U.S. exceptionalism. As we entered into 2025, that dissipated after a couple of months. But at this point, it just seems that market players have different takes as they look at 2026.
Yeah, and if you look at the ranges last week, week to date, the Dow was down about 0.7%. S&P 500 barely improved. Is that bullish sentiment as we take stock in the markets? Well, let's get into what we're doing today for the Monday session. European markets today, this is how we're shaping up. It's been patchy as we've gotten going. We're seeing the FTSE 100 weaker. The DAX has been stronger, but actually giving back a little bit of the earlier gains and only up less than 0.1% now. So some of those gains just not sticking around. The French market's down a third, and the Italian market that was leaning positive now flipping weaker, down 0.2%. The sector improvers, where we've been seeing some appetite this morning. Don't forget there's an oil and gas story out there in the market around Venezuela and some of the geopolitics playing out. Also the war in Ukraine still. So oil and gas has been stronger. Rounding that out, it's around resources, technology and banks, a favoured area of the European markets in 2025. That is also improving at this hour. Some of the losers, where we're seeing a bit of a pullback in the early hours of today. Food and beverage is down, utilities, real estate, telecoms, defensives are not faring so well for the Monday session. And US futures, we pointed out the patchy old trade that we saw at the back end of last week. The Dow actually up Friday session, up 0.4%. The Nasdaq up about 1.3%. US futures this morning, though, in lockstep, suggesting a modest tick higher as we kick off the shortened festive trading week.
It is a shortened trading week, and we're also not expecting huge comments coming from Fed officials. However, we have gathered several over the last couple of days. So let me run you through what we have heard in terms of some of that Fed speak. There is no need for the Fed to change interest rates for several months. This is according to FOMC member Beth Hammack. The president of the Cleveland Fed made the comments in an interview with Wall Street Journal following the Fed's third 25 basis point cut in a row this month, citing greater concern over elevated inflation rather than the labor market itself. Hammack's sentiment was echoed by the New York Fed president, John Williams, when he spoke to CNBC on Friday. Listen in.
I don't personally have a sense of urgency to need to act further on monetary policy right now, because I think the cuts we've made have positioned us really well, and to really try to, I think one goal here is to stabilize the labor market. I don't want to see the labor market cool too far. I want to see inflation come down to 2%, without doing undue harm to the labor market.
Meanwhile, the race to be the new Fed chair is ramping up as well, with senior administration officials reporting that Fed Governor Christopher Waller had, quote, a strong interview. Other candidates in contention include BlackRock's Rick Rieder, who will be interviewed at Mar-a-Lago at the end of the month, while Fed Governor Michelle Bowman is reportedly no longer in the running. Now, prediction markets still have the National Economic Council director, that's Kevin Hassett, as the favorite for the job. Amid the interviews, concerns continue to grow over the potential impact to Fed independence. We got an update on the situation from the chief economist at Apollo, Torsten Stoxx.
What the conclusion, of course, here is that it all becomes about, can the new Fed chair persuade the other FOMC members about whatever his view might be. In this case, if the new Fed chair wants to cut interest rates, there are 12 voting members. The new Fed chair needs to come in and convince everyone else why it's a good idea to cut interest rates.
So let's discuss with our next guest. Kuku Agbu-Blois, Global Head of Research at Societe Generale, is joining us this morning. What do you make of these two different narratives? You hear Fed speakers suggesting that perhaps this is a moment to pause, at least in the first quarter of 2026, but then expectations of a new Fed chair suggesting that we might get a more dovish central bank.
Absolutely. I think this was one of the key focus for markets. And I think it goes down to the Fed independence theme. And obviously the last time the Fed lost its independence was in 1971 around the Nixon shock. But they have put in place a mechanism to prevent a president from dictating monetary policy. This is why you have 7 governors who are elected, essentially selected for a long time, and then 5 regional president out of a pool of 12. So in order to have the Fed really become dovish, no matter the data, you would need to have the majority of the voting members to essentially have this view. And our view is that whilst you may have a distribution of outcome for more dovishness, the base case scenario is for the Fed to still be data-driven and maintain its independence. Because we're not at a stage where the majority of the voting members have been selected or chosen by Trump.
But how can they remain independent, and how can they just focus on the data? If, for instance, we see someone like Kevin Hassett taking this job, given how close he is and has been with the president?
Well, simply because it's everybody has one vote. So it's not as if the Fed chair decides the outcome. And as long as the contributing members are essentially looking what their fiduciary duty, so to speak, is to the economy by making sure that we don't get in an environment of uncontrolled inflation, then you could have a situation where you have more dissent. And this is actually what we had in the latest decision for the 25 basis point cut. You have to remember that even Jay Powell was chosen by President Trump in the first term. So it demonstrates that, obviously Jay Powell doesn't have the same view as Kevin Hassett, but ultimately our belief is that the system is designed in such a way that it will create enough diversity of opinion. But even if we don't have a Fed that is driven by independence and the data, I think that we are in an environment where, and this is where it gets interesting, where a more dovish Fed would be a problem if inflation and wage inflation were to come out of control. But one of the interesting insights is AI. There is a risk that AI, or a potential for AI, to be putting pressure on wage inflation if you look at the number of jobs that are being lost in the essentially displacement of workers, particularly in the service industry. And that could essentially increase productivity and limit the amount of inflation one could see, because the AI adoption occurs faster than expected. So this is yet to be seen in the data, but I think that could be the surprise for 2026. It's
certainly something to watch, isn't it? I spoke to a number of the central bankers in Europe about it the other week as to whether they're mindful of any structural shifts that they're seeing in the labour force. I mean, it feels evident that in the white-collar area, young professionals entering the workforce, you've already seen a level of disruption. If that were to manifest itself in 2026, are there any levers that governments or central banks can pull here to counteract those forces?
Well, I think the mandate of the Fed and central banks is maximum employment and price stability. So today we can see weakness when it comes to the job market, and that's why we see the Fed cutting. And you have to also remember that the original sin around what I call the origin is still around COVID, where government and central bank had to put $25 trillion of monetary and fiscal policy, was ultimately to save human lives. And that created a reaction function because we have an inflation outbreak, 500 basis point of tightening. And now the Fed is simply trying to go back to our start, a neutral level of interest rates. And that's what they're doing. We think it's probably around 325, 350. But it is still providing the Fed with a Fed put if the economy were to weaken. So to answer your question, I think it's sort of a good problem to have in the medium term in terms of AI adoption and a higher productivity rate for businesses and companies. And so if that were to go too far, then this is where regulation will have to come into place. But I don't think we are there yet.
Let me road test the data, because you talk about the independence of the Fed and the data that they're assessing. But the reality is, after we've seen some of the delayed data, the new baseline that some of the data will form could be somewhat skewed. And we'll see the data be impacted right through 2026. That is on a monthly comparison. I think it was October this year to October next year, for instance. And some of the series even from here, because the collection was much later than anticipated in the month of October and some into November. How do you think about the skews and the distortions in the data as policymakers rely on their credibility to see through some of those distortions?
That's an excellent question, and we saw that over the past 12, 18 months where we're talking about hikes and then a recession. The summer of 2024 was quite interesting in terms of imminent monetary policy mistakes, etc. I think there's Galbraith, the economist, who once said you have two types of forecasters: those who don't know, and those who don't know they don't know. Which really shows you how complex the forecasting is as an exercise. So there are a lot of moving parts. So the way the economy is behaving after COVID and the work from home dynamics, and you have the online, the shift in the makeup of the economy. One thing I do believe, though, is the what I would call anti-fragility of the system, which is related to Nassim Taleb. In other words, the market is becoming a lot more resilient, having survived so many external stressors. Think about tariffs.
Yeah.
One of the we are actually in the middle of what I call a massive volcanic eruption of silence when it comes to tariff. Because this was after Liberation Day what created all the volatility, and we've seen a lot less discussion about tariffs, raising tariffs against different countries, and all of a sudden the market is climbing the wall of worry because this is no longer a topic. So
well, they're
I
just
think
resigned to the fact that they're sticking around, right?
Absolutely, because companies need the global economy to thrive. When you talk about data centers, semiconductors, this relies on China's ability to export rare earths metals. So the long story short here is that data has been uncertain, but the system in of itself is able to adapt to an environment that's been very uncertain. So look at we had the SVB not that long ago. We had the Credit Suisse, for example. The reaction, the speed with which monetary and government have been able to react to maintain sort of the show must go on type environment is what fascinates me in terms of markets and the management of tail risk outcomes. Mm-hmm.
It's very interesting times, and that's why I would like to ask you to focus on Europe for a moment, because some of the remarks from Fed officials suggest that they are in a good place in terms of, okay, let's wait and see what happens with the cuts that we have done so far. The ECB has argued the same from a different point of view, of course. But when you think about the Bank of England, what do you think it will take for the Bank of England to be in a position to say we're also in a good place?
Yeah, so I think when it comes to Europe, so clearly we had the view that we would cut more, but I think 2% is sort of the floor, and that's unlikely to. And we're even talking about hikes if you look at what the long end of the curve is pricing. And in the UK, since Brexit, the UK had an issue with the labour markets in terms of a tighter labour market environment. That's why the UK typically exhibits more inflationary pressure than other markets. So I think they've cut, and we've seen lower inflation forces. But I think, as we mentioned at the beginning, it will be data dependent in terms of fiscal policies, whether we'll get another least trust type of shock as the government implements policy. But so far, the credibility of the government is improving, and the bond vigilante haven't sort of attacked, quote unquote, the gilt market for now. So we will have to see, but the path of least resistance suggests a moderating inflation outlook for the UK.
Can we tackle where markets go more broadly from here? Because we also kicked off this hour talking about the sentiment gauge from Bank of America. And it just really struck me as strange to talk about extreme bullish territory in markets at the moment when we've had very choppy trading sessions in recent weeks. Do you think it's bullish sentiment? And do you think we are now primed for a pullback? And this is almost a counterintuitive index where you climb a wall and then suddenly you have a sell-off, a reversal.
I mean, markets have two phases. They slide down the slope of hope, which is typically where a bear market occurs when people are too optimistic, and they climb a wall of worry. And this year I was struck by how many conversations we had with investors on what could go wrong. So if everybody is so concerned about the AI bubble, is the boom or bust, and when it will crash, etc., I think we are more in the latter, i.e. climbing the wall of worry. And we are also witnessing the fourth industrial revolution. And this is why I'm quite excited about markets going forward, because I think it's really an earnings boom that is occurring. Just to give you some numbers, I'm speaking at 150 words per minute. We typically write, we can read at up to 300 words per minute. The human brain can think up to 4,000 words per minute. But AI processes information at 1.5 billion words per minute. Right. So what I find is...
Faster than us?
Faster than us, absolutely. And the question is, how do you use it? So for me, it's the Paul Tudor Jones quote that says, "No man is better than a machine, but no machine is better than a man with a machine." So the productivity that AI will bring us in terms of our ability to process more information, learn a lot more stuff. Obviously, there's hallucination risk, but this is about how you train people to be able to prompt smarter. I think we revolutionize our ability to add value to the ecosystem. So long story short, we're in a sort of a new cycle that's creating value. Earnings are pretty strong in the US, Europe, etc. And I'll probably conclude with the great philosopher Mike Tyson, who once said, "Everyone has a plan until they get punched in the face, so make sure you're hedged."
So let me look at the other side of the argument, because clearly you're very excited about markets for the new year, in particular when it comes to AI. But what are you therefore concerned about the most?
Yes, so that's a good question. So I think the key concern would be war, major conflict, commodity shock. Clearly, we have the oil price that's picking up with the Venezuela situation.
So from a low base.
From a low base, yeah. And if this were to go out of hand, it could trigger an environment where we will have to deal with input cost inflation. And that is pretty much the story of sort of the Ukraine war with Russia, where interest rate has to spike. So that would be one. But outside of that, I mean, the massive elephant in the room is climate change. I think we're sort of toast, quote unquote, pun intended actually, because we're on the path of 2.5, 3 degrees. And if you look at green technologies, etc., it's being used for data centers as opposed to replacing fossil fuels. So this, I think, for the medium to long term, is probably the biggest worry I have. In the short term, it will be, yes, more conflict at this stage. And probably other idea would be if you have obviously an AI catastrophe in terms of the models, or a sort of disruption in the whole ecosystem around technology that could essentially create more endemic crisis.
Well, the last two feels like the ones Trump cannot control. Any import to price spike feels like Trump would get very involved, but the last two perhaps out of his control.
Absolutely.
Coco, thank you so much for joining us. Fantastic to hear your thoughts, and thank you for joining us in this festive week. Coco Abivvax with us, Global Head of Research at Stoxx. Coming up on the show, 9 further drug makers signing deals with the US to lower the cost of their drugs to avoid more tariffs. We'll have details next.
Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick, and here's the CEO of Siemens Energy, Christian Bruch.
business leaders should not stay quiet in a world which is super complex. We sit in a privileged position, and we have to use that to ensure that society remains prosperous, stable, successful.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this.
Watching the oil price today around some of the geopolitics as the US is in active pursuit of an oil tanker in international waters near Venezuela. Authorities say the ship is flying a false flag and is a sanctioned dark fleet vessel that is part of Venezuela's illegal sanctions evasion. Authorities have already seized 2 vessels this month, including one on Saturday. US President Donald Trump has ordered a blockade of sanctioned tankers entering and exiting the country's ports. Venezuela has accused the US of trying to steal its resources. So oil prices are picking up morning session. You can see this is how it plays out. We're on the 61 handle on Brent as we march higher, almost 9/10 up on WTI, 57 the handle, and gold again into year end, climbing further 4,400 the level as we bounce again 1.7%. Peace talks aimed at ending the war in Ukraine have ended with no resolution. US, European and Ukrainian officials met in Florida. US Special Envoy Steve Witkoff said those talks and separate ones with Russian negotiators were productive, but ultimately have not been able to find a deal to end the bloodshed.
Let's refocus our attention on what's happening in the markets this Monday morning. Abivvax shares are sharply higher amid renewed rumors of a takeover bid from Eli Lilly. France's Le Lettre reports that Eli Lilly met with France's Treasury earlier this month in a bid to gauge the chances of regulatory approval for a potential takeover. The stock is up more than 1,000% in 2025 after positive trial results for its ulcerative colitis drug in the summer. Last week, I asked the CEO, Marc de Garidel, whether he was having conversations to prepare indeed for a potential deal.
We have always, conversation with big pharma, and again, my view is that as a CEO and as a team, our role is really to develop, the best drug available, possibly for patients in those both conditions, and that's what we can control. We don't control what the big companies will do, but we are certainly excited about the work we are doing. And we've been greeted again by the medical community as becoming possibly, the next standard of care in ulcerative colitis.
9 drug makers have signed deals with the Trump administration to lower the cost of certain medication in the US. That's in exchange for a 3-year reprieve from their products being hit by Trump's planned tariffs on the pharmaceutical sector. It follows a number of similar deals in recent months struck by companies such as AstraZeneca and Novo Nordisk, as President Trump looks to lower the cost of drugs in the US to match prices abroad. And let's get it out to Carolyn for more. Carolyn, it's been an eventful year for Big Pharma as they've been negotiating with the president and his advisors. What's the wash up here? Because I think many people will agree that prices of drugs in the US are far, far away expensive, much more so than other jurisdictions. But what is the wash up for some of these Big Pharma companies?
Look, I'll get to that in just a second, but there are so many different angles here. I want to start with the domestic political one for U.S. President Donald Trump, because as you pointed out in your introduction there, one of his major campaign promise was to lower drug prices in the U.S. for consumers who are facing on many fronts an affordability crisis. And we know, as you rightly pointed out as well, drug prices in the U.S. are among the highest in the world. So getting that deal across the line has been incredibly pivotal for Donald Trump. Here's what he said after signing that deal on Friday.
Starting next year, American drug prices will come down fast and furious, and will soon be among the lowest in the developed world. So in other words, whatever the lowest price for a certain drug, of which these companies make much of it, whatever the lowest price is, that price will come down to that price. So we will get the lowest price anywhere in the world. If they're lower in England than they are in Germany, we take the England price.
And Karen, you asked me about the implications for the drug makers, specifically here in Switzerland. Of course, I'm looking at Roche and Novartis, and the implications could be pretty dire when it comes to profitability, you would think, because again, the US. For both Novartis and Roche, one of its biggest markets, 50% of their revenues come from there, a highly lucrative market in the past. So how will they offset that loss of profitability? Of course, it can only be offset by higher prices elsewhere. This is something that I talked to the CEO of Novartis about a few weeks ago. Take a listen.
What's going to happen here is you're going to have fewer launches in public markets in the target countries outside of the United States. So I think prices in the U.S. will adjust, but they'll adjust modestly. I think really what you're going to have is a situation that unless overseas countries, these particularly as the administration is focused on the G7 plus Switzerland and Denmark, if they don't raise their prices up to reward innovation and on par with the U.S., companies won't launch in the public market in those countries. So really that's, I think, the administration's core goal is how do you get countries overseas to reward innovation and pay their fair share of the innovation ecosystem that the US has historically been supporting. And that's how I think this will ultimately play out.
And that was the CEO of Novartis a couple of weeks ago. The CEO of Roche, meantime, he doubled down on that call for some of the countries, including Switzerland, to raise their prices in a newspaper interview over the weekend, saying that Switzerland has the most to gain, but also the most to lose if Switzerland were to not follow through on that deal, saying tax revenue and jobs are at risk if that deal is not being honored. Of course, a huge internal domestic discussion already as to whether that would lead to higher healthcare premia. The health minister already pushing back, saying, no, we're not going to offset the lowered prices in the US. Quick check of the stock prices of Novartis and Roche. Roche down this morning to the tune of 0.9% at the bottom of the index this morning. Novartis pretty much flat for the year, though. Both stocks have seen pretty nice gains, though, of more than 20%.